It's a pleasure to be here today. It's not often at one of these kind of events the fund manager gets up and talks about poor performance. But I've got to say, in the last 20 years of investing, this last 6 months has been particularly disappointing. When you run a concentrated strategy, like the high conviction fund with just 25 stocks, there is nowhere to hide. And what we've seen has been unprecedented. I'm going to discuss 3 things today with you that have cost us money, but more importantly, outline the case for why we do think they are going to bounce back, because we have seen these kind of things happen before. Now, it may not feel like it to many of you because volatility is so low. If you look at the VIX, risk is very low at the moment. But from our perspective, some of the valuation dislocations we see in the market today are on par with the valuation dislocations we saw in COVID. So the first thing that's cost us has been not owning Australian banks in the last 6 months. And I want to set the scene for you today and I guess share with you some of our thinking on this and why we don't think the outperformance of the banks is going to continue. Whenever we're looking at a company, we always look firstly at the operating environment and then the valuation. So let's start with the operating environment. Commonwealth Bank is a great company. I hear that a lot. Many of you have told me that in the past. But let's look at the earnings per share over time. These charts go back a decade. That yellow one at the top there is CBA. Their earnings have grown at 0% per annum for 10 years. The earnings have not grown. As Don highlighted earlier though, there has been dividends, but the earnings, the business hasn't grown. If you look at the others, which is NAB, Westpac and ANZ, as you'd expect, they have underperformed CBA on an earnings basis. So the earnings have fallen about 20% over the last decade. People say, well, yeah, okay, but it's about to get better. We've seen this before. And it is worth highlighting, there has been 3 major periods for the big 4 banks. The first one was 2000 to 2008. Credit growth through that period was averaging 7 to 12%, and earnings grew very strongly. And then coming out of the GFC, so 2008 to 2014, you had competition shrink. If you remember in the GFC, Commonwealth Bank was allowed to buy Bankwest. That would never happen today, but you took a major competitor out. And then you also saw Westpac and St George merge, which again would never be allowed to happen today. So you saw competition shrink and earnings grew. But the last 10 years have been the rise of competition. You've seen non-bank financial institutions, you've seen Block and Square, you've even seen Graham at Metrics attacking them on the corporate lending side. Macquarie, they were 0.5% of mortgages in 2013. Today they're 5.5%. So there is competition everywhere. It should have surprised none of us that the earnings haven't grown and are unlikely to grow in the future. But let's look at valuations, because these to us look very stretched. Given that earnings outlook, the multiple of the Commonwealth Bank, in our view, is very, very high. There's been a lot of inquiries, supermarket inquiry. I'm going to call for a bank valuation inquiry, because paying 22 times for CBA when the earnings haven't grown for a decade, to us, is a bit much to take. Now, it is worth paying a high multiple for earnings when the earnings are in the sink. Maybe bad debts are really high. Well, no, the bad debts are actually quite low. You heard that from Graham and Don as well today. In fact, the outlook for bad debts over the next 3 years from the market, and these are the best analysts publishing estimates, is at or below the lows of pre-COVID. So if you look back over the last 20 years, they're at the low point. So these banks are not under-earning. To us, the bank multiples are very hard to justify given the earnings outlook, and as a result, we are happy to continue with our position. But one thing that is interesting is that there is some value out there in the market. We don't think it's in the banks. This is the Commonwealth Bank valuation chart, and this is ResMed. And it's a very special moment at the moment because you can buy a dollar of earnings from ResMed at the same price as you can buy with the Commonwealth Bank. Now, since 1999, when ResMed came onto the market, this has never happened before. We think there's a lot of value in ResMed, but owning ResMed in the past year has cost the strategy as well. I want to outline the case for ResMed. ResMed doesn't get to 21 times without something going on. And what's going on is weight loss drugs. Some of you may have heard of them. They go under the name GLP-1s, but they also go under the brand names Ozempic, Wegovy, Mounjaro. You've probably heard about them. You might have seen them. You might have even taken them. What they are is a drug which used to be used in diabetes and now is used in weight loss. You take it daily at the moment. It's through an injection, but there are oral alternatives coming down the pipe. And what it does, it makes you not want to eat. I had a friend take it, and they lost 12 kilograms in 6 months. What the studies show is over a year, if you take it and take it every day, you're on average losing about 15 to 23% of your body weight. So these really do work, and they work because you don't want to eat. But there's 3 questions I think that need to be answered. The first one, will the costs come down? In the US, which is the main market ResMed operates in, although they do operate globally, at the moment these drugs are costing $1,000 a month, US, out of pocket. It's a very expensive drug. Now I think prices will come down, and I think there will be some insurance coverage, but if you actually if you look at the obesity numbers and said everybody gets insurance coverage, the US health budget will be blown up. So there's a question mark on that. A really big question, we don't know the answer to this, we know they work. Will people continue to take these weight loss drugs? Well, my friend lost 12 kilograms. I had dinner with him last week, true story, and he said, I'm off it. He didn't enjoy food, and he loves steak, he loves ice cream, and he loves beer. And he didn't like any of those 3 things, and he said, this isn't worth it. So, big question, will people continue to take these over time? You've got to take them all the time. As soon as you stop, the studies show the weight comes back on, and it comes back more than you had previously. And then the final one is this. CPAP, that's the mask plus the device which ResMed sells. It eliminates sleep apnea. It takes your sleep apnea from whatever it is to 0. And people who are on this kind of therapy report great sleep. Will weight loss drugs take sleep apnea to 0? Because if I'm your physician and you lose weight but you still have sleep apnea, you will still be the right, I guess, clinical and diagnosis will be to get a ResMed mask. And so there are some risks around this, but I think there are some big questions around it. What we like to look for, after having done the work on this, is what's actually happening in ResMed and why we like it. They are the market leader in sleep. It's typically a 3-player market, but the number 2 player, Philips, has had major product recalls. This has been going on now for 2 to 3 years, and just last month, Philips signed up to a deal with the FDA, the regulator, to say we will not sell devices to new patients until you're satisfied we're ready to. Now, typically these promises will last 2 to 5 years. And so we believe ResMed is in a fantastic position to continue to grow earnings, as they have. I mean, if you look at this and you compare that to the Commonwealth Bank chart, these earnings are growing very strongly. The most recent quarter, revenue grew 13%, profits grew 20%. ResMed is delivering. You might say, okay, that's sort of interesting, but I'm not fully convinced. You know, weight loss drugs still are an overhang. I want to just jump into a quick example of why long-term threats create great investment opportunities. JB Hi-Fi. In 2018, JB Hi-Fi, by many in the market, was considered uninvestable because Amazon was coming. Amazon announced their entry in the market in 2017. What were the fears? Well, the fears were that sales would decline. JB Hi-Fi could potentially lose market share, and they would have to cut prices. Why would you possibly buy a $50 HDMI cable or an Apple charging cable when you could buy one on Amazon and get it delivered in the next couple of days? What was the outcome? Well, the outcome is the orange line. The earnings continued to grow, and in fact, if you look at 2017, the earnings almost doubled through that period. Now you might say, oh yeah, but COVID's in there. Well, yes, but COVID, we've largely lapped that now. And so these earnings have grown through time. And what was the outcome? And this is where the ResMed read-through is. Electronics competitors exited, so Retrovision, Godfrey's just shut down the other day. I don't know who was buying those vacuum cleaners in the last little while, but they're out. Bing Lee's slowed down. Harvey Norman hasn't really innovated. JB Hi-Fi grew. Amazon grew. Amazon grew very fast, 37% last year. So both players grew, and that was the outcome. What happened to valuation of JB Hi-Fi? Well, you know, let's call it a normal period. People would pay 14 times PE for JB Hi-Fi, And then Amazon came and everyone said, well, we're only going to pay 12 times PE. That means you get your money back in 12 years, or you're about to have a pretty big downgrade. And then most recently, you can see now people are paying over 15 times for JB Hi-Fi. The stock has tripled through that period. So these long-term threats offer material, outsized returns for patient investors. We think that will be the case with ResMed. The final thing that's cost us money has been, I know what you're thinking, if these guys just lose a lot of money. I don't think this will be the case, and it certainly hasn't been the case over the long term. But gold, we can debate gold supply and demand, but it's fair to say gold prices have been very strong recently. We do think it plays a role in the portfolio, given everything we're seeing with inflation in the markets. But Newmont, which took over Newcrest in the middle of last year, has materially lagged the gold price. So you can see here the US dollar gold price. It's up roughly 20% in the past 2 years. Newmont is down 40%. It's very rare to see commodity equities deviate so much from the commodity price. Why has that been the case? Well, cost inflation has really hit the miners. It hasn't just been Newmont, it's been all miners. They downgraded guidance for 2024. We think that is going to be one-off, and 2025 looks excellent. And they cut their dividend. You might say, okay, this doesn't sound very good. The market has certainly put Newmont in the sin bin. We've been buying a lot of Newmont, just in the past week, in fact. Why do we like Newmont? Well, they are the BHP of gold. They own more than half of the world's tier 1 assets. There are 17 tier 1 assets in gold in the world. These are large, low-cost, long-life assets, and you can see them there. They really are the lowest cost, largest producer of gold. And they're getting shareholder friendly. So one thing we saw from BHP and Rio, they cut dividends and everyone puked it out and no one liked it. And since then, the returns have been very strong. And they were very strong because they did a few things that Newmont has basically copied. The first thing is a fixed dividend. It works out about 3.3% a year. They said, we're going to pay that year in, year out. The second thing is a fixed capital budget. So instead of growing the CapEx in the future because they see these great projects, they're not doing that. It's going to be $1.3 billion a year, every year. They're selling non-core assets. So at the moment, they've got 6 assets for sale. It'll probably be $2 to $3 billion of capital back to the balance sheet. And then all excess free cash flow goes into buybacks. We've seen this playbook before. We saw it with the iron ore players in 2016. We saw it with the oil and gas players in the middle of COVID, and they re-rated. We think Newmont is going to be the next mining sector, and gold to re-rate on the back of that. It really offers a compelling opportunity. So the last 6 months haven't gone our way, but we have seen these kind of periods before and have bounced back strongly through history. If you do invest with us, really thank you for your patience. And if you don't, and the ideas did resonate, please reach out. We'd love for you to invest alongside me and the team in the Firetrail Australian High Conviction Fund. Thank you.